Well, welcome everyone to our YouTube live, and you'll probably notice that behind me here you can see Jack Bogle, because there was actually a doorstop on the wall and everybody said that they kept swiping to get rid of the stain on their screen, but in fact it's just a doorstop. So I thought we may as well put Jack Bogle there. And bear in mind you can also vote on who we have as the picture there week to week. So let me just show you where you can vote. So I'm going to have a Twitter poll in order to do this, and this is how you can vote. So this is the Twitter poll that we had previously. We had 4 possible contenders. We had Kathy Wood, Parak Patel, who's hilarious. I love his Twitter channel, his Twitter account. It's very funny. Jim O'Shaughnessy, who got very few votes, and Jack Bogle, who won. He had half the votes. Anyway, so I'll change it from week to week, and that way A, we'll cover the doorstop, and B, we can celebrate someone in finance, which is always a good thing, or economics, or physics. In fact, I wouldn't mind having some physicists there.
Me?
Or Laura, yes, or Teddy or Laura, yeah. Okay, so let's switch back and start looking at some of these questions. And
This one in Slack.
oh yes, and today I had my vaccination, so that was also on Twitter, and apparently I was a very brave boy, and so I will not potentially get this virus, which is always a good thing. So let's start the questions. And Trevor, thank you very much. You've supported us via our YouTube membership. Thank you very much. You just joined, I think. Richard Wood says, who's a member, says, thanks for the simplicity and clarity you bring to these topics. My pleasure. Price to earnings ratios. DDOG 600 plus, MELI 1000 plus, PYPL 58, SQ less than 400. Your thoughts, please. Thank you. Yeah, actually, I'm talking about this in the next video, which I'm just doing the kind of slides for right now. Now, obviously, you can justify valuations like that if interest rates are very low. But of course, interest rates are not going to be low for very much longer. And in fact, they're already going back to more normal rates given the level of growth that we're going to be seeing. And if that's the case, then it's very hard to justify very high valuations. So there are a whole bunch of things you can look at to suggest that is the new normal. For example, take a look at Kathy Wood's funds. For example, ARK-K. Look at the individual stocks in ARK-K and look what happened to the prices of those stocks as interest rates have started rising rapidly. And you'll see that it hasn't been a catastrophe for all of them, but they've certainly come down in terms of valuations. And I think that's going to be the case. As yields grind higher and as growth normalizes, we're going to see some of these frothy valuations start to dissipate. That's not necessarily bad for the entire market. So the S&P's hardly wavered. The Nasdaq's lost a little bit more than the broad S&P, but it is a difficulty for growth stocks, which have had a massive premium. So I think interest rates are really the writing on the wall for a lot of the froth that we can see in markets. So that would also include things like zero coupon bonds. If you're not familiar with the idea of a zero coupon bond, it's the idea that you buy something, you pay something today, you sell it at some price in the future, and those are the only 2 cash flows. You don't get any kind of income between the time you buy and the time you sell. Now, for a zero coupon bond, that's not very attractive if treasuries are offering a reasonable risk-free income. If treasuries aren't offering a reasonable income, suddenly zero coupon bond assets like gold, like Bitcoin, become more attractive. So that becomes less attractive as risk-free assets start offering a reasonable rate of return. everyone was complaining that treasuries weren't offering an income when 10-year yields were at 0.8. Now everybody's complaining that yields are increasing. But personally, I think that it's a sign that the economy globally is healing. But unfortunately for these stocks, Richard, it means that some of those valuations will have to come down. It's not going to be pretty, I suspect, for some of the stocks which are hugely overvalued. And the one everyone's talking about, obviously, is Tesla as well. But I can't comment on those individual stocks themselves because I don't usually look at single stocks. Next question, also from...
It's like, there's a member question.
Is it from Lenin Velaturi?
Oh, I don't know.
I'll answer it because I can see he is a member.
No, it's from RC now.
Okay, well let me just answer Lenin's first because he's up at the top there. Thanks for the education, Lenin says. How to keep it simple and not hear the commotion and noise whilst investing. Thank you very much. He was just making a nice comment, I think. Thank you, Lenin. Arsenio Penesi says, hi, to build a fixed income portfolio from scratch in this financial environment, which asset classes should have larger allocation? Should bonds be reduced in favour of REITs and high dividend ETFs? Well, the problem I think at the moment is it's not really clear how much yields are going to increase. For example, we're already seeing 10-year yields in the US move up to 1.7% today. And of course, now it's 18th of March 2021. And the question is, how much further is it going to go? I've done a video about that as well. That was last week's video where I talked about whether rates are going to go back to where they were just before the pandemic, or if the Fed does normalize its policy, in other words, it raises interest rates, then we'll move away from this 10-year regime when rates were ultra low. Personally, I think it's more likely that we'll move to a kind of interim world in between now and the normalized version where 10-year interest rates are between 2 and 3%, which is where they were for that decade after the global financial crisis. And if that's the case, then we haven't got much further to go, maybe 50 basis points, 70 basis points from where we are now. That's 0.6% to 0.7%, somewhere around there. And if that's the case, then if the duration of your fund is, say, 5 years, 6 years, then you'll lose about 3% on your fund. So it's not a catastrophe by any means. And in the equity market, that would hardly make you blink. But for the fixed income market, it is a big deal. So if that's the case, then not too bad. If we do suddenly move into this new regime where the Fed is forced to normalize its policy, it won't have very low interest rates for much longer, then we could see the 10-year at, say, 4%. And that would really be a big deal if you have long duration government bonds. But whatever you do, I mean, making your fixed income allocation shorter duration probably makes sense. You can do that both in credit. You can buy short duration credit funds. PIMCO offers one, for example. It offers more than one. But there are also ETFs, which from other issuers, which give you short duration credit exposure. Or you can go for short duration in a wide range of fixed income funds. So that's probably something to consider. I think it would take a pretty brave person not to reduce the duration of their portfolio at the moment, because it is likely that rates are going to increase. Okay, so that's something to consider. Real estate investment trusts are interesting, I think, at the moment, because some of them are interesting. It really depends on the sector exposure for the real estate investment trust. And to show you what I mean, let's take a quick look at a REIT. Now, this is just one example of a REIT. It's not necessarily, there's nothing very special about this one. but it is diversified across sectors, which is why I wanted to show this to you. And also because it shows you the sectors themselves. Let me just share that. There we go. Right, so this is the iShares Global REIT ETF, and the ticker's RWT. And this is available to US investors. I don't think this particular one is available for UK investors. I think there is a version of this for UK investors. If we look at the exchanges it trades on at the bottom, I think we might be able to see whether a UK version is available. Anyway, the reason why I wanted to show you this is because it shows you the sector exposure. So if we go to the portfolio section and we look at the exposure breakdown, and I love these pages for iShares funds. They're so beautifully laid out. So immediately you can see the geographic exposure, but what I wanted to show you was the sector exposure. Now, retail real estate investment trusts, if you think that retail on the high street in the UK, in the shopping malls in the US, if you think that's going to suffer and carry on suffering, not just because of the pandemic, but because of the shift to online purchasing, then maybe a retail REIT isn't appropriate for you. And remember, about a fifth of your capital will be allocated to retail REITs if you buy this fund. Residential REITs, I think, still makes sense. Yeah. Industrial REITs still makes sense. Offices, again, if we move away from office working after the pandemic ends, then office REITs are obviously going to suffer. They won't be such a safe way of getting income by renting out office space for companies. So again, you're already talking about a fair chunk of the allocation here in two troubled sectors, retail and office. And then you've got specialised REITs, diversified, healthcare and so on, hotel and resorts. Now, all of these have suffered to some extent. And if you look at the performance of this fund, we should be able to see the effect of that. You can see that this thing really suffered during the crisis. It went from a price of 14,885 down to, let me see if I can move the mouse accurately. No, about 8,700. So that's a fairly chunky loss over the sell-off in the pandemic. But you can see that now it's recovering really quickly. So as a recovery play, that might be an interesting thing to do. Also, the other reason why you buy a real estate investment trust is because it offers you fairly high income. So if we look at the, unfortunately it has a fairly high fee. So the management fee for this one isn't too high, 0.14, but some of them are quite expensive. But if we look at the actual income on this, I wonder if it's got the dividend yield. Yeah, so the 12-month trailing yield is 2.6%. Normally these are quite generous when it comes to income. So that's the other reason you'd go for a real estate investment trust. It gives you exposure to the upside. Many of them have been beaten up by the pandemic, so there will be a recovery that you'll get paid, a recovery premium, if you like, that you get paid as the pandemic subsides, and you get a fairly good income. So that could be interesting, but just be careful about the sector composition is all I'd say, because some of the behavioural changes which we've had through the pandemic will probably persist beyond the end of the pandemic. Just be aware of that. Right, let's move back to this. Okay, so please like our stream because it helps us. Just click on the like button. And the other thing that helps us a lot is if you tell other people about us, obviously, because not many people do know about us. So it'd be great if you told your friends about PensionCraft and share via social media. Yeah. And of course, we do offer membership. And of course, now we have a YouTube membership. So you can click on join underneath the image of this screen if you're watching online on your personal computer or your Mac. Then there should be a join button, and that way you can ensure that we remain independent, as Trevor has done. Trevor Martin has just joined. So do join us. That helps us a lot too. Right. Next question is
In Slack.
in Slack.
4.
Right. So the first one is from Frey, who has a nice quote from a poem which is German, which is part of Winterreise, which I personally very much like. He says, I'm considering including some small caps with a title to value. Okay, they've exploded since March, plus 75%. It doesn't feel great buying these ETFs now, but I'm in for the long run. Should I wait? Well, again, this is one of the things I'll be talking about in my video. So I'm kind of preempting it here, but the idea is that if we do get a recovery which continues, at the moment, the Fed has very much said we're going to keep rates low for a long time. So that's kind of soothed fears in the Treasury market. Yields have stopped accelerating upwards at an incredible rate. We haven't seen a spike upwards in yield as we did when he spoke a few weeks ago. So he avoided the taper tantrum by soothing markets. And that made people perhaps go back to the trades which they were doing before, which is growth over value. Now, personally, I think that that's just a short-term hiatus as we move towards this world of the Fed normalizing rates. It's going to take a while, but the data is going to improve, and it could improve faster than we expect. If that's the case, the Fed will react. They will start signaling that their asset purchases will slow down and that they'll start thinking after that about raising interest rates. And growth is not going to do well if that's the case. Remember, the Fed hasn't said anything about raising interest rates. They said they haven't even thought about thinking about raising interest rates so far. And yet we still saw growth suffer, and we saw value rally. So that's what's led to this massive value rally. And once we actually see the Fed raise interest rates and cut back on asset purchases, I think that'll be a much more severe rotation away from growth and towards value, probably. So I wouldn't worry too much about buying those funds if you're in it for the long run. I wouldn't worry too much about buying value and small cap value as well, because small cap value is a double factor. It's a kind of combined factor which has done very well historically, but which has done atrociously recently over the last 5-6 years. But I think that is another factor which could well come back to perform well in future. So that I think is not unreasonable, Frey. RM, another member, YouTube supporter, is saying, which investments provide the best return to risk profile if I have some significant cash to deploy now? Perhaps one idea with high correlation and one with low negative correlation with the market. Okay, return risk profile. The thing about return risk profile is it assumes that momentum will continue. So in other words, we're not at a regime shift. The reason why I say that is because if we look back over the last decade, growth is what's outperformed. So if you were a long-term momentum investor and you look back over a decade, you just buy growth. You'd buy large caps, you'd buy Microsoft, Apple, Google. Those are the kind of stocks which you'd go for. So I'd be slightly cautious about doing that at the moment because, as I say, I think we are in a bit of a regime shift from the post-global financial crisis world where rates were low, growth outperformed, and large cap tech stocks have done very well, and small cap growth stocks have also done very well recently. But I think we're probably shifting to a world where the prices of those assets have ballooned, and usually that means that they underperform in the years ahead. Not necessarily, they won't necessarily fail. A lot of the tech companies which have been created over the last decade are great companies, The problem is that you're just paying too much for them, and if you've paid a lot for them, then the price appreciation won't be so good in the near future. So that's the only worry I'd have, I think. So the question is, you have to guess what the return's going to be for the assets that you buy. My personal choice, I think, if I had to choose, would be to go for something like value. So one of the value stocks, if you are going to go for single stocks, I wouldn't. I'd go for a value fund, and probably maybe even a combination of something like value and quality. So you could go for one of these multi-factor funds. That might be one way to go. So personally, I think that's something that's going to perform quite well in the next year or two. And then something which is uncorrelated, well, it's very hard to choose something which is uncorrelated. You'd have to go for fixed income, because anything in the equity space would be correlated with anything else. So they're probably, I mean, high yield credit is not very attractive at the moment because spreads are absolutely tiny. So you really aren't being paid to take high yield credit risk. So what you could do is wait until there is a credit problem and then buy high yield credit. Now that is highly correlated, fairly highly correlated with equity. It's around 0.6. If you go for something like HYG, or which is a high yield fund, one of the largest ones, or something like JNK, which is another high yield junk bond fund, the correlation with equity is about 0.6. But if there was a big correction, then that would be a good time to buy something like that. It'll give you some diversification, but it's still equity-like. And then if you want to go for something even less risky, maybe investment grade credit, that would give you low correlation with equity. So that might be the way to do it. And maybe go for short duration. You can get short duration investment grade credit funds. But at the moment, I think the risk reward for investment grade credit, or even junk bonds, in particular junk bonds, is not very good. Emerging markets as well, obviously, are in a difficult place at the moment because of the effects of the pandemic, but also dollar strengthening is bad for them. And as the US pulls ahead of the rest of the world, the dollar is going to strengthen, interest rates in the US will increase, and generally that makes emerging markets suffer. So I'd be slightly concerned about that. So I think for the uncorrelated bit, you're going to have trouble at the moment. I'm not sure exactly what I'd go for with that. Maybe something like short duration government debt, diversified, so something like a BND, which gives you global investment grade and treasury exposure, plus gilts, plus JGBs in Japan. So it is diversified globally. It doesn't give you much of an income at the moment, but hey, it's giving you more income than it did. So the income on these funds will go up over time as they pick up these higher coupons. So yeah, maybe something like that would give you the diversification. And then the second question from RM is about what short duration fixed income do you recommend in US and Canada? PIMCO has some interesting short duration funds, and you can always buy short duration US treasuries. There are lots of funds which give you exposure to that. Or if you are feeling a bit more adventurous, you could go for short duration high yield. But again, at the moment, I'd probably avoid that. But those are your choices, I think. I was wondering if convertibles might be interesting at the moment. Maybe not. No, I won't talk about that. But it might be something to look at. So take a look at convertible bond funds. Just see what you think of those. But it is quite complex but a very interesting asset class. And at the moment, it could be interesting, I think. And they've done very well recently. Whether they continue doing well is another matter. But that might be something to look at. Lenin Velaturi says, hedged versus non-hedged. how to make the decision. Right.
Like, maybe.
Oh yeah, please do like our stream, because obviously it helps us and it lets other people know that we're around. So let's see how we're doing on the stats before I answer that question. 368 people watching, only 130 likes. Oh dear. Time to get Teddy out, I think, because oh, he's powered up. Oh look, you always do this lazy thing, Ted, where you rest on one leg. You've got it. Oh, Teddy. Can we stand up? Oh, very good. Very. Oh, he's dropped it. Whoops. Right. So back to the question, which is about EQQQ or EQGB. So EQQQ is the Nasdaq tracker, I believe. So the question here is whether you should hedge your Nasdaq exposure back into sterling. Now, the answer to the question really depends on whether you think that the dollar is going to strengthen versus the pound. Recently, over the last 6 months or so, obviously we've had sterlings appreciate versus the dollar, and that's been a big drag for dollar-denominated assets if you're a UK investor. Going forward, I think it's likely that the US will pull ahead of the rest of the world simply because they've got this massive stimulus plan, which is much bigger than the stimulus we've got in the UK or in Europe or in Japan or anywhere else for that matter. If that's the case, then the dollar would appreciate probably as interest rates rise in the US and as growth picks up in the US more than it does elsewhere. And then ultimately it'll lead the Fed to raise interest rates. So if that's the case, then you wouldn't want to hedge, because if the dollar strengthens, for sterling investors, that's attractive. You want sterling to weaken versus the dollar. So if you agree with me that sterling is going to weaken versus the dollar, then don't hedge. If you don't have a view about currency, if you don't care, then there's no harm. There's not much harm in hedging. There is some cost involved in hedging due to the interest rate differential, and that's something to consider. But generally, it really depends on your view about sterling versus the dollar. And of course, if you think that sterling's going to carry on strengthening versus the dollar, then you wouldn't hedge. But if you don't have a view, probably hedge as long as the cost isn't too high. And if you have the view that sterling's going to weaken, don't hedge. So that's the kind of summary. Somebody did a super chat, and
it's in your Slack channel,
and it's in the Slack, right? So, Chess Dad, thank you very much. Nice to hear from you again, Chess Dad, who often joins us. It's really nice to see you again. Says, is there a rule of thumb to estimate earnings improvement for banks? Is there a rule of thumb to estimate earnings improvement for banks and insurance companies based on an X% increase in the 10-year rate? You can do that, actually. Yeah. I guess what you're referring to there is so just to kind of fill people in if they're not familiar with this idea, as the yield curve steepens, so as the, say, 10-year becomes higher, the 10-year yield increases, and if shorter rates remain low, then the curve steepens. Now, banks make money by lending. Part of their money comes from lending. So they borrow at the short end of the curve, they lend at the long end of the curve, and they make a difference. They pocket the difference between the two, and that's called the net interest margin. And if curves steepen, then that net interest margin increases. The question is, how much does it increase? There was recently a paper from the ECB talking about how much of a difference that makes. And they actually did quantify what a steepening of the curve would do to the bottom line for banks. So you can quantify it, although it's not easy to do. So I'm not sure exactly. And for particular banks, depending on their sources of revenue, if they lend a lot of money, if it's a big lending bank, then the steepness would make more difference. And if they fund themselves in a certain way via the wholesale markets, it really depends on the bank as well. But is there a general rule of thumb? I'm not aware of one, but it would be cool if there was. But I'm not aware of it. But roughly the calculation would be how much of the revenue comes from lending, how much net interest margin difference would there be, and then multiply the amount of lending by the net interest margin change, and you should be able to work out some kind of sensitivity. But it wouldn't be easy. Okay. And in fact, if you could do that, you'd probably make more money from becoming a bank strategist at an investment bank rather than investing your portfolio yourself. Okay, next question is also from a member, and this is from Frey again. Thank you, Frey. What would be the trigger for you personally to re-enter the stock market? Would this be applicable to the rest of us? Well, the trigger's now actually, but for me it's more of a personal matter, a kind of personal matter, which is that PensionCraft has finally started to pay enough to live off. Not enough to save, unfortunately, but enough to live off for myself and Laura and Teddy. So, we might be in a position to start saving soon. Not much, but a bit. And if that's the case, then I won't be depleting my savings anymore. So now I'm in a position where I can start to save money, and I'm not going to be completely dependent on my savings not crashing so I can eat. So again, this is why I say never copy somebody else, because your circumstances won't be the same. I went through a divorce, I lost half my pension, I had very little income because PensionCraft wasn't paying. So for me, those were my circumstances, and the trigger for me was that PensionCraft did start paying because you all kindly have started funding a kind of lifestyle where we can do this full time. But that wasn't the case. I wasn't sure that was going to happen. It was a gamble. And for you, obviously, the circumstances will be different. I suspect many of you have a regular job, or maybe you're retired. But you've got to consider your own circumstances when you invest to build a portfolio that works for you. And there isn't just one way to invest. Everybody has their own style. And that's another reason why I think it doesn't really make sense to copy other people necessarily. It's a natural way for us to do things because it's just human nature that we try to find someone who does something that we think makes sense, and then we might copy it. But I think for many people, that's not a good idea. So that would be my trigger. That was my trigger, is my trigger. And I will be starting to drip feed money into equity markets over the next couple of years to increase my equity allocation. And it's not applicable to the rest of you, no, unfortunately. Okay, so please do like this stream. It helps us a lot. And I see we have 400 people now, 200 likes. So half of you like it. That's good. And I'll go back to answering some of the questions. And James Kelly says, sell tech, people, buy back in lower. Right, there you go. And then Frey replies, James Kelly, not really. The buy sell YouTube channel here. We allocate and stick with it. I like that. Okay, except Ramin, he's excused. Thank you. Dave says, which of the following would you consider the more conservative investment in today's stock market? A world index or an index of smaller, relatively cheap markets? Oh, interesting. So if you do buy a global index right now, you'll be buying a big chunk of the US. So that'll be 50-60% of your portfolio. Or you can go for cheap markets like Greece, for example. No, I mean that's the risk, right? If you go for a cheap market, it can be cheap for a very good reason. And if that's the case, then it may not recover, or it may not recover in a reasonable amount of time. So the kind of market I'd go for would be one that should be temporarily cheap. And that's a really difficult judgment to make. The UK was temporarily cheap because of Brexit, but now we've got the headwind, which is the reality of Brexit and the difficulty with trade and the trade friction, and also the very long scarring effect we'll probably have from the pandemic. So, I mean, those are the kind of considerations you'd have to have. Why is it cheap? How long will it be cheap? And will it stop being cheap for a good reason? That's the difficulty, and that's the judgment call you'd have to make. So I think it's safer to just buy an equity market, buy the entire equity market globally, just buy a global tracker. That's the kind of more conservative choice, I'd say. But if you do think you can spot the temporarily cheap markets, then yeah, you could try going for that. Again, have a look at my video where I talked about the Japanese bubble, because at the beginning of that video I talked about which markets had fallen but really never recovered. So for example, emerging Latin America, so emerging LATAM countries have fallen and never really recovered after the global financial crisis. Italy's another place. Many European countries like Spain is another market. Greece is another. So those are the countries where this whole narrative about equity markets always rallying in the end never really worked out. Or at least if it is going to work out, you'd have been much better off just buying a global index rather than waiting for them to recover. So I think the conservative choice would be go for global. And simpler, right? Simpler, because you don't have to think. And usually it works out. James Kelly, always more about the tech. Okay. Tech is about to lose a third of its value. Do what you will. There we go. Yeah, and Frey says, as world allocation is quite unchangeable, it would by definition be more conservative. Yeah, I agree with that. And BMBM365, Boom Boom 365 says, when this stimulus check comes through, which is about now, they should have gone out already, get ready for a massive pump in the markets. Yeah. So some people will spend their stimulus check on markets, but remember that for 10 million people, they're probably thinking about paying their rent rather than investing in markets. So about 10 million Americans are out of work that weren't out of work in February last year. So those people probably won't be spending it on stocks. But for some people, yeah, you're right. They will be spending it on stocks. And I wouldn't be surprised if we see a jump in markets as a result. Oh dear. Okay. Then it gets a bit harsh, the exchange there. Let's move on.
And I've got a question right at the bottom from a member.
Oh, is it on Slack?
It's going on Slack.
Oh, it's going on Slack. Right.
Say something.
Okay.
While it's going on.
Yeah. Why not click on like, and why not join us? You can click on the join button, and then you can support us on YouTube, and then you'll get a little crown next to your name, and then we'll always answer your questions at the top of the list if that's the case. So that's one way to get pushed to the front of the queue when it comes to answering questions. And for example, here's a question from Gary, who's one of our supporters, and Gary says, rising yields attract capital to the USA. Rising growth attracts capital to the emerging markets. Who wins? Well, the problem is that if interest rates are increasing in the US and the dollar strengthens, that's generally bad for emerging markets. And the question is, will growth spill out into the rest of the world? Now, it was interesting. If you listen to Powell's statements, if you listen to Powell's press conference from yesterday, which I've done many times now, but he talks about how US growth may spill out into the rest of the world. But if you actually look at the size of stimulus in the US relative to the rest of the world, it's disproportionately larger. So the question is, will there be enough increase in exports to the US in order to pick up growth in, say, Thailand or Vietnam? And the answer is probably no. unless they do some kind of stimulus themselves. Perhaps they've handled the virus very well. So South Korea, for example, did an incredible job of controlling the virus, so they never had much of a hit. But other countries in emerging markets have been hit quite hard, and they are poorer. They may be, maybe too expensive for them to vaccinate all of their adult population. So they'll just have to wait for herd immunity, and they will have scarring in their economy as a result. So that's why I'm worried that the US pulling ahead of the rest of the world may not be good for emerging markets. A stronger dollar as well. Remember, many of these emerging market countries like Turkey have issued a lot of their government debt and their corporate debt in US dollars. They call it hard currency emerging market debt. If that's the case and their currency weakens, like the Turkish lira right now, then servicing that debt becomes much more expensive. And then we're talking about things like defaults increasing and a credit problem. And then banks become less likely to lend. And then the economy seizes up because we have this whole spiral where credit becomes an issue. And then we could have an EM crisis as the currency sells off as well. So a weakening currency, credit problems, and potentially a sovereign credit problem as well, because if they've issued a lot of sovereign debt in dollars, that's a problem too. So that's why I think this isn't a necessarily rosy picture for emerging markets, even though it might be a rosy picture for the US. That's why I'd be worried. Okay, so Swig.
Super chat. Put it in Slack.
Oh, and a super chat from super chat from Tom Peachy. Talk about the Tesla bull trap. Love the content. I'm not sure what you were talking about, Tom. I guess what you mean is that Tesla's recently started rallying again, and if it is the case that interest rates start increasing again, so the Fed has said we're going to be accommodative for a long period of time. That means that growth stocks like Tesla may rally again. So many people may get back on board with that trade, buy back in, or maybe buy more Tesla. Then if we do see interest rates increasing again, then obviously that's going to be a problem for companies like Tesla. Also, if the Fed actually raises rates or cuts back on its asset purchase program, because currently the Fed is buying $80 billion of treasuries every month, $40 billion of mortgage-backed securities every month. If the Fed starts easing back on its asset purchases as it sees the economy improve, imagine what could happen to rates then and what would happen to growth stocks. At the moment, it's flat out, rates at zero, lots of asset purchases, its balance sheet's growing really quickly at 120 billion a month. And even now, we've seen growth suffer. So it'll be that much worse if the Fed actually starts cutting back. So poor old Jerome Powell has to somehow communicate that and not cause a taper tantrum. It's going to be really hard to do. They may just have to kind of suck it up. They may just have to assume that there is going to be some kind of taper tantrum, but they'll try and avoid it. But, we'll see. Okay, back up to the top, and oh dear, I've got lots of questions. So I'm gonna start answering from the top. Somebody's noticed Jack Bogle. That's good, on the wall behind me. I noticed that's a young Jack Bogle, right? So if you do want to vote on the next poster that I put up next week for the next week's video, then you can always do that on Twitter. I'll put a Twitter poll out, and on Twitter we're just at PensionCraft. And then you can vote on who we have on the wall. Chuck Diesel, hello. Hi. My question is about value investing books. What would you recommend other than the Intelligent Investor security analysis? Well, the Intelligent Investor, the best thing about the intelligent investor is the introduction by Mr. Zweig. He's really good. He's an amazing journalist. I love his stuff. But the book itself is unreadable and largely irrelevant to people who invest nowadays. In fact, I wouldn't necessarily go for a book, and I've said this before. I'd just look at, well, there is a good book actually by Damodaran who talks about security analysis. That's a good book. But also he's got lots of videos. So if you prefer to learn with videos, then that might be something to consider. That's certainly a good book. And the other thing I'd say is, actually look through some annual reports and try and make sense of them. They're often quite good to read. They're often really well written. And it's often quite interesting reading them. So that might be another way. But there is a nice spreadsheet that comes from Damodaran where you can work out the risk premium. But also you can do evaluation using his spreadsheet. It's fairly easy to use. He shows how to do it. And there are videos how to do that as well. Okay. Next question. Frey says, your budget for wallpaper was extremely low, apparently. That's slightly insulting, Frey. But in fact, we rent this place, so I'll pass your message on to our landlord. Somebody says, Ed 209 on the wall, please, Ramin. Very good. That was from Talbot Sunbeamer. Thank you, Talbot Sunbeamer. Sasha says, if you're investing over the course of your lifetime with a goal of pure growth, would you simply invest in a cap-weighted global tracker, or would you use any different strategy? Yeah, I think I probably would go for a cap-weighted global tracker. It's interesting that you say pure growth. I guess what you're referring to there is a factor. I guess if you do want to do factor investing, then remember that growth could start underperforming quite seriously. So if you do factor investing, it has to be the case that you believe in that factor, whether it performs or not. So just as you can't time markets, you can't time factors. So you've really got to stick with it during the decade of underperformance that you could quite easily have. And remember, if value's outperforming, growth is underperforming. So that could be, if we do go back to a world in which value outperforms, then it could be some period of time when growth underperforms. So you will have to have the kind of cognitive discipline to stick with a factor. But you get growth exposure with a global equity fund, which is cap weighted. So you still get the growth exposure, it's just less pure. Next question.
There's one in Slack coming in anyway.
Okay.
There we go.
So RM says, would you recommend Invest in Fear? Okay, that's one of the books I've written. So the reason why I wrote the book was because I'd heard that grannies were investing in volatility exchange traded notes. So if you're not aware, you can buy exchange traded notes which are linked to the level of VIX. It's actually a bit more complicated than that because they have to buy futures in VIX in order to give them the VIX exposure. You can't buy the index directly, and that's where all the complication comes in. But the whole book, a large amount of the book, is about roll cost. So that's the idea that with a futures curve, you have a term structure, so that if you're always buying the kind of long end of the VIX futures and selling the short end of the VIX futures curve, normally what you have is a negative carry cost because you're selling something you're selling something cheap and buying something expensive. It's only when the curve inverts that stops being the case and that the roll actually generates an income. So if you do want to learn about all that stuff, yeah, Invest in Fear is a good book. Some of the funds don't exist anymore, the ones which I had in the book, because it's quite a dynamic market. Some of the funds actually, hit kind of risk limits, and some of them just had the roll cost was so big that they actually got wound down, the exchange traded fund. But yeah, the general principles of the book I think are quite interesting. And if you do think that volatility is very cheap at the moment, so VIX, if you look at the VIX at the moment, so just have a quick look at VIX. I'll share this so that you can see it. So let's have a look at the VIX index. That at the moment is extremely low compared to where it's been since March last year. So it hit a pretty much, well, I think it did hit an all-time record of around 85% in March last year. Then it very rapidly fell, but it's been fairly elevated. It's been above the long-term average, which is about 15% for some time. Only now is it coming back down to that long-term average. So if you think that's too complacent, if you think that we are entering a new regime where volatility is going to be higher, or we could get a big equity sell-off, and you want something that's going to gain in value if that happens, then that's where volatility exchange traded notes could be interesting, because obviously they pay out a lot when equity markets fall. So that is a fairly effective hedge. And there are also certain exchange traded notes which reduce the roll cost. So that might be something to consider too. Yeah, so there we go.
Other questions?
Yes. Back to the questions. So another question from a supporter, which is Bryn Coed, who says, what sources of information can you access to find value funds ETFs? And it's to consider. Okay, well, there are various, it depends where you live. If you live in, let me just share my screen again. If you live in the UK, then Just ETF is pretty good for finding ETFs. I've found them to be very useful. We use them a lot at PensionCraft, and yeah, so that's something to consider. Or if you live in the US, then ETFDB, let me spell it correctly, is a very good website. Again, free. Both of them are free if you're just looking for ETFs. And they've got a database, and they've also got a screening tool so that you can look for particular types of ETF. And if you pay for it, you get certain things which are if you pay for it, you can download some of the data. So I've found both of those very useful. It really depends on where you live. Let me switch back. Whoa. Nope, you don't want to see that. There we go. So how long have we got? We've got 5 minutes, time for some more questions. Please do like. It's still not too late to like. If you're watching the replay also, you can always like us. And back to the questions. Sasha Smith says, hi Ramin, what's your opinion on ETF distribution based on GDP as suggested by Just ETF, having a larger allocation towards China and a lower towards America, creating more country diversification? Yeah, that's interesting. I guess, yeah, I think it's interesting. You'd also have a very large allocation for India, for example, which may not be what you want. So I think it's certainly interesting to have a higher China allocation. Just be aware that it comes with a higher risk. That's the problem with having a higher China or India allocation. But over the long term, I think, Chinese growth probably will be higher. Equity market growth may be higher. So that's certainly interesting. And for India too, probably over the long term. If you are going to be investing for 30 years, then yeah, I think that certainly makes sense. But I'm not sure I'd do it in proportion to GDP, because I think that would probably have too much of an allocation to emerging markets, where generally growth tends to be higher, but equity market performance isn't always greater. What is true is that risk is greater. And when equity markets sell off, generally EM sells off more. Not always, but usually. Just be aware of that risk. That's all I'd be worried about, I think. But if you do have the discipline not to sell, and having a higher equity allocation for China, India, some parts of emerging markets, yeah, not a bad idea. Yeah. VJ says...
No, that's super chat.
Oh, okay, super chat.
Senor.
Very good. Alessandro Bergamo, thank you for your super chat. That's great. Do you think the popular technical indicators like MACD or RSI might work just because a lot of people use them? The self-fulfilling prophecy. Yeah. It's interesting. When I used to work at an investment bank, one of the guys I used to work with as a strategist used to swear blind that these technical indicators worked. And for me, I just thought they were complete nonsense. But the only reason why they would work is because lots of people use them. So, yeah, I think that's the only reason why. Because generally, if you backtest, if it was that easy just to buy stocks where the MACD indicator or RSI is telling you to buy, then, we'd all be hedge funds, right? But it's not really that easy. But, I mean, just to pick up things like momentum in a structured way, maybe that's interesting. But I think something like valuation is probably much better. That is something which does work over a long period of time. So, valuation is probably the better thing to look at. We've got a second super chat, actually, from Chestad. If you were traveling into the future, like in the movie The Time Machine, I love that film, which investment books would you bring with you? Well, in the future, I suspect it wouldn't be the same investing as it is now. I suspect a lot of the investment will be done by algorithms, and humans probably couldn't keep up. So I'm not sure that I'd be using a book at that point. Also, I suspect we'll augment our intellect so that we'll be more computer-like in terms of our cognitive capacity, which would be great. We'd all be quants if that was the case. And it would be easier to be a quant if you could just plug in a thinking module, a bit like Wurzel Gummidge. Most people won't know who that is. Okay. But if I did have to take take an investment book with me, I guess it would be something to do with, I guess valuation would still be valuable in the future. My guess is that would still be appropriate. So something like a valuation book, maybe something by Aswath Damodaran, I think would be a good thing to take with me. That's probably what I'd do. Yeah. Okay. So it's 8 o'clock. So I think we'll probably leave it there. Thank you all for joining us. It was great fun. Wonderful questions. And thank you for all of our supporters. Our many YouTube supporters now who are asking questions and who kind of crowded out the rest of you. But hey, that's the cost of not supporting us for these sessions. But thank you for the great questions from everybody, and thank you for joining us, and thank you for liking the stream. It's still not too late to like it now. Remember, you can always join us as well. You can support us on YouTube. There's a join button underneath every video. We produce a free weekly market roundup every week. I write it every Friday. I'll try and make it interesting, so please do sign up for that. And you can join us on Patreon, and that way you can join us on Slack and ask questions on Slack. And we now have 700 supporters via that as well. So yeah, it would be great if you interact with us more. We love the interaction, and have a great 2 weeks, and see you with more antibodies against COVID in 2 weeks' time. Bye, everyone.